afternoon. Welcome to another episode of the Moving Markets Podcast with Jeffrey Dunyan. I am Jeffrey Dunyan, your host. I am the owner and founder of Safe Option Strategies. Very glad you could join us on a Monday afternoon. Pretty wild day in the market, mostly down trading for a lot of the stocks that we follow, and certainly for the three major indexes. In today's podcast, we're going to talk a little bit about sort of a light week for economic news, but another big week for earnings, not so much in the tech sector, but with some other things going on. Also, I'm going to give you my take on why the market rallied so much at the end of last week and then sold off so much today. And a lot of it has to do with the Fed. There's just no getting around that. Certainly some of it can be attributed to earnings, but a lot of it has to do with the Fed. And I'm gonna just tell you my honest opinion of Jerome Powell today. So hopefully that's something that you can look forward to. As always, if you want to check out more details about Safe Option Strategies, some of the education packages that we offer, go to sostrades.com. That's sostrades.com. Look at some of the different things that we offer. Subscribe if you see a package that appeals to you. But at the very least, if you enjoy this podcast, make sure that you subscribe to our YouTube channel. No cost involved in that. Make sure you like us if you're watching this on some other platform, and please send us in some comments or some questions about stocks that you trade or things that you're interested in, and we'll do our best to address that when we can. Enjoy the presentation. All right, so today we had a pretty good sized sell-off in the market. I don't think anyone should be completely stunned or completely shocked by that, because over the weekend, our buddy Jerome Powell simply could not keep his mouth shut. He did an interview for 60 Minutes. I'm sure that interview was recorded earlier last week and probably maybe even at or before the time that he made the announcement on Wednesday. If you look at what, and I'm gonna focus mainly on the S&P. Let me bring the S&P in here. If you look at what the S&P did over the past few trading days, this kind of paints the picture, and I'll pop this out so that I can draw on it a little bit. This kind of paints the picture of how Jerome Powell and the Fed have influenced the markets over the past week of trading. When the Fed, and let me back up even a little bit before the Fed made their announcement for rate hikes or rate increases, or in this case, they kept the rates where they were. Prior to that, there are a lot of people, a lot of analysts, a lot of big brokerage firms, a lot of hedge fund managers, mutual fund managers, and a lot of individuals who have been pricing into the market 3 or 4 or more rate cuts before the end of this year. And what I believe is the folly in that, what I think is an absolute mistake in doing that, if I can illustrate it right here, is that we only have, after the meeting that we just had in March, we only have after the meeting we just had in January, including the meeting we have coming up in March. 1, 2, 3, 4, 5, 6, 7. Now, for those really myopic, nutty individuals who may have believed that we were going to get 6 rate cuts before the end of the year, and there were some of those people out there, I honestly don't know what they were thinking. I don't know why anyone believed that we would get up to 6 rate cuts before the end of this calendar year. Those individuals who are thinking 3 rate cuts or 4 rate cuts before the end of the year, you've got to figure at least half of the meetings that the Fed is going to hold between now and the end of the year, they're going to make rate cuts. The big problem with that is the only reason the Fed would have for cutting rates that much is if we start going into a recession. That would mean that the next 2 quarters in a row would have to have negative GDP. And we've been seeing just the opposite of that. We've been seeing a higher GDP in the last 2 GDP reports. We've had better numbers than expected. In fact, considerably better numbers than expected. And so I think it's a little bit of a folly to think that we're going to see a recession come in the next couple of quarters. It could happen. I do believe it still could happen. I don't think it's going to happen. I'm not going to get off on my conspiracy theory about thinking the numbers are being fudged a little bit or not trusting in or believing in the numbers. I'll spare you that. I do sometimes suspect that that's a possibility, but even though this idea of 4 or 5 or 6 rate cuts is insanity, in my opinion, there is some validity, and this is based on comments Jerome Powell made a number of months ago. There's some validity in the idea that we could get 2, 3 rate cuts before the end of this calendar year. And I don't think that's completely off the table yet. But even 3 rate cuts mean that after March, you got to have half of the rest of the Fed meetings this calendar year produce a rate cut. And that's still, I think, a stretch. Maybe not off the table, maybe not out of the question, but for sure a stretch. So what's happened is you've got people baking into the market this idea of multiple rate cuts, and the reality is it's probably just not going to happen. Jerome Powell on Wednesday of last week, he didn't necessarily throw a wet blanket over the idea that we could still get a few rate cuts before the end of the year, but he absolutely squashed the idea that one could be coming as early as March. And there were a lot of people that felt that was likely, or that that was at least, at the very least, a strong possibility, if not a probability. And kind of dampened a little bit the idea that we may get one as early as May. He didn't completely close that door, but I would say he at least partially closed that door. So the market, because a lot of people think that is baked in, had a little temper tantrum. And on Wednesday, the market sold off and it had a pretty deep sell off. But the problem with that sell off is it was just what I described it at. It was kind of a temper tantrum of these people who are thinking that he should be cutting rates, or upset that he's not cutting rates. And it was an overreaction. Plain and simple, it was an overreaction. So after some really phenomenal earnings that came in the form of Microsoft on Tuesday night, the sell off on Wednesday, I think, was even more unjustified. And then Tuesday, you had a lot of people jump back in on Tuesday and say, "Hey, we still like where things are going, and the temper tantrum has subsided, and the adults are coming back in to be in charge." And so on Thursday, things moved up, and then on Friday they moved up even farther. And Friday was more a function of the reports from Amazon and Meta that took place on Thursday after the market closed. Those were 2 phenomenal earnings reports. Those 2 companies did amazing. And even to a lesser degree, Microsoft improved considerably on Thursday and Friday, in part because it was an unfair reaction, I think, on Wednesday that was exacerbated by the Fed's comments. But also, I think I think it's just unfair for Microsoft to even sell off in after hour trading on Tuesday, because their report was really good. And Microsoft is still clearly leading the tech world in a number of different areas. And that's just a robust, strong, good company to be invested in right now. So you've got kind of this tale of two cities. Now, fast forward over the weekend, you get Jerome Powell. And again, it was probably a taped interview that happened maybe before he even made the Fed announcement on Wednesday, what the Fed would do. But you had a 60-minute interview where, again, he took that same wet blanket, he threw it over the fire again, and kind of squashed the idea that we were going to get a rate cut in in March or in May. He didn't say definitively it could not happen, but he really dampened the expectations. And he even went a little bit farther than that and damped the expectations of a rate cut anytime in the immediate future. If we go back to that list of the Fed upcoming meetings, um, you've got them in March, May, June, July. Then they skip August and meet in September. They skip October and meet in the early part of November, and then they meet again in December. He kind of alluded to the idea that it it may not happen the way anyone thinks they want it to happen, or the way other people want it to happen this year. It didn't, like I said, didn't close the door at all on rate cuts taking place, but certainly didn't give a lot of optimism to it. And so, just like what happened on Wednesday, a little bit of a temper tantrum today. This was another function of people thinking that the Fed is squashing their hopes of rate cuts, and that's a horrible thing and an awful thing for the Fed to do. And so the market sold off today. The good news about today, if you were to zoom in on it a little bit, the really good news about today is that after initially dropping pretty dramatically in the early part of the trading day, I think at one point in time, the Dow Jones Industrial Average was down. Um, at one point in time, I believe it was down almost 400 points. Uh, I clicked on that drawing tool. It's not letting me draw. Almost down 400 points. And then by the end of the day, it was down about 270 points. So it came back quite a bit. And at one point in time, I think it was only down 170, 180 points. One point in time, it looked like this market was on a runaway train to be down really, really far. And then, it managed to rebound pretty dramatically. Still closed down a fair amount, but not nearly as bad as it could have been. As it relates to the economic calendar for the rest of the week, and this does make it a little bit trickier to figure out exactly how to trade and what to trade. You had some reports that came out today, the PMI composite ISM services. Those aren't real dramatic market movers. And if you look at the entire rest of this week, maybe international trade bumps things a little bit up or down on Wednesday. The jobs report can always be a market mover if things come in really, really hot or really, really cold, but it has to be a pretty big miss. Lately, there have been a lot of misses to the upside. The market had the jobless claim, or I should say to the downside. Jobless claims have not been as bad as what people thought they were going to be. Um, but I don't mind playing a little bit of the conspiracy theorist on this one because I think those numbers are unreliable. I think they continually get revised down. I think uh, the Bureau of Labor Statistics, whether it's political or incompetence, I think you've got one of the two things going on there. And I just think their numbers that they give us each week are not things that we can rely on, especially when you consider last year. I believe the first quarter of the first couple months of the year, later in the year, and it didn't get a lot of news and didn't get a lot of fanfare. They had to revise their numbers down by over a half a mil, or almost maybe just under a half a million jobs that they had reported in the early part of the year. They had to revise down. So I don't trust the numbers that come out of the Bureau of Labor Statistics. They're off every time, and they're having to revise them every time. But there's just that's always a report that does have the ability for a day or two to drive things up or drive things down. What's going to be a bigger deal today? If you notice on several of these days, you've got uh, some economic speeches going on by Federal Reserve policymakers. These are members, these are Fed govs from the different branches of the Fed around the country, and a lot of them are scheduled to speak this week. And any one of them at any time could focus on the negative. They could focus on the positive, and all those speeches have the ability to move the market for a short period of time. If what you got was, say on Wednesday, where you've got Kugler, Collins, Barkin, and Bowman all speaking on Thursday, or excuse me, Wednesday, if they all came out and sounded very, very hawkish on the current situation and specifically what their expectation is for rate increases, rate decreases, um, quantitative easing. If they all painted the same picture, that could drive markets up pretty strong on any given day this week following those comments. So that's something to be aware of and watch for. As far as earnings go this week, this is what I believe is going to be the bigger driver of things this week. And let's start with tomorrow morning. Tomorrow morning, you've got Eli Lilly and Spotify. I think those are the two that people are going to be looking at mostly. Um, Neither one of them are by themselves massive market movers, but they have the ability to kind of jolt things and move things a little bit. On Tuesday afternoon, after the bell rings, I'm looking most closely at Snap and Ford. Snap is not, they're not in the category of a Meta or Facebook or Microsoft in terms of a tech company. They're purely a social media company, but I got to tell you, they are the social media platform that my younger adult kids use as much or more than any other social media platform. My adult kids use text messaging, Snap, and Marco Polo more than any other. They definitely get on Instagram. They definitely look at TikTok videos. They definitely use Facebook a little bit. The biggest one they use for communication with each other is Snap, and primarily because it has that feature that erases their messages after a short period of time. Maybe not a big enough company to drive the NASDAQ or drive the markets, but if the markets were on a little bit of a roll already, and then Snap comes in with some really good numbers, that could push things farther, or it could put a little bit of a damper on things if the market was moving one direction, like if it was moving up and then Snap came in with a really weak report. Ford, I have owned a lot of shares of Ford over the years, and I own a lot of shares of Ford right now. It's one of the biggest holdings in my portfolio. I've done really well on Ford. Ford got hit hard today. Um, I'm anxious to see what they report. I don't know if today was a function of somebody leaking something on Ford. Um, I was surprised that they were down as far as they were. They literally had a 4.5% move to the downside. It may be a function of consolidation between their recent highs of 12.50 and their recent lows of just under $11 a share, because they ended up at about 11.50 at the close of the day. But I honestly don't know what the primary thing was driving Ford Motors to the downside. But they got hit hard today. I was scanning the news, seeing if I could figure out what is going on. A report from a couple of days ago said that Ford reports January U.S. sales are up 4.3%. These are all older news stories from the end of last week, so I'm not sure why they were driving Ford Motors. No pun in, well, actually pun intended. That's a good one. I should keep that pun. But I don't know what the reason was that the stock was being driven around the way it was today. I'm going to continue looking tonight and maybe have some more commentary on it tomorrow as they're reporting. But as we go through later in the week, on Wednesday morning, Alibaba and Uber, CVS, again, none of them by themselves big market movers, but collectively they could move things a little bit. PayPal and Disney are going to be interesting. PayPal because I think it's just a fun stock to watch. I like. It's been a little while since I've done a trade on PayPal, but I have traded them a fair amount in the past, and I think it'll just be interesting to see where they go. Disney, I used to own a lot of Disney stock, and I do not like the wokeness of Disney. I see no personal evidence that Iger is making the changes that he talks about making, and I don't like this company anymore. I still like some of their, I certainly like their older movies. I'm a big fan of the Marvel stuff, the Star Wars stuff. But I hate the woke agenda that they're pushing. I think companies should stay apolitical, and it bugs me when any company, whatever their politics are, it bugs me when they're political. And Disney has been one of the most political companies for a while now, and so I don't trade them anymore. But I do watch them. I'm fascinated to see what happens. So there's some other stuff going on later in the week, but those are the ones that I'm most focused on as we do the podcast later in the week. We'll talk about the results of some of these earnings reports and whether or not some of these Fed comments are driving things one direction or the other. Hope you'll join us for the rest of our podcast later this week. And in the meantime, hope you're having a great start to your week. Thanks, everyone. Bye bye.